Welcome back to the channel. I'm really glad you're here today because what we're about to talk about could completely change the way you think about investing, building income, and protecting your money at the same time. Most people believe they have to choose between growth and safety, between aggressive stocks and boring income assets. But the reality is that with the right strategy, you can actually combine both. Over the past years, I've talked a lot about individual ETFs and how each one serves a specific purpose, whether that purpose is maximizing growth, creating consistent income, or protecting against downside risk. But the truth is, no smart portfolio is built using only one ETF. Real portfolios are built using combinations that balance each other out. And right now, based on where the market is heading into 2026, there is a very powerful two-ETF strategy that I believe can offer a rare mix of strong growth potential, reduced volatility, and reliable monthly income. This isn't hype and it isn't guesswork. It's simply about understanding how money flows, how investors behave during different market cycles, and how certain assets naturally rise when others struggle. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. As we move deeper into this decade, the market environment is shifting in a big way. Volatility is becoming more common, uncertainty is increasing, and investors are no longer as comfortable blindly chasing high-growth stocks without considering risk. When markets become unstable, money naturally starts to move towards safety, and one of the most reliable safe zones has always been dividend-paying companies. These are businesses that generate strong cash flow, manage debt carefully, and have the financial strength to keep paying shareholders even during tough economic periods. At the same time, another major force is shaping the future of income investing, and that is the gradual shift toward lower interest rates. As interest rates fall, yields on bonds, treasuries, and money markets also fall. That means fixed income investors will be forced to look for new ways to maintain their income, and historically, that money flows straight into dividend stocks and income-focused ETFs. This is exactly why the first ETF in this two-fund strategy is SCHD, the Schwab U.S. Dividend Equity ETF. SCHD is built around financially strong, high-quality American companies that don't just pay dividends but grow them consistently. It selects its holdings based on several powerful filters such as dividend history, dividend growth, free cash flow, and return on equity. These criteria help ensure that the companies inside SCHD aren't just paying dividends for show, but are actually earning enough money to support and increase those payouts over time. During uncertain market conditions, this type of financial strength becomes extremely valuable. Many people noticed that SCHD lagged behind some other dividend ETFs during parts of 2023 and 2024. And that mainly happened because its strict yield requirements caused certain lower yield but fast-growing companies to be excluded. However, as the market shifts toward income once again and interest rates begin to trend lower, SCHD's higher yield becomes a major competitive advantage instead of a weakness. Now, most investors would naturally think that the next step is to simply pair a dividend ETF like SCHD with a traditional growth ETF, such as the NASDAQ or the S&P 500. And while that approach can work during strong bull markets, it also exposes your portfolio to full downside risk when markets fall. Technology stocks in particular remain highly valued and extremely volatile. That means if the market suddenly turns, those types of ETFs will feel the full impact of that drop with no built-in protection. This is where the second ETF in this strategy completely changes the game. Instead of relying purely on price growth, the second ETF focuses on turning volatility into income. And that ETF is JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. JEPQ provides exposure to NASDAQ stocks while simultaneously generating high monthly income through covered call strategies. Instead of simply holding tech stocks and waiting for prices to rise, JEPQ actively sells call options on a portion of its holdings and collects premium income from those options. This allows the ETF to generate large cash payouts, even when markets move sideways or decline. Unlike traditional growth ETFs, JEPQ only exposes about 80% of its assets directly to the market while using the remaining portion for income generation. On top of that, JEPQ does not hold the exact same stocks as the standard NASDAQ ETF because it applies additional risk filters that help reduce downside exposure. This means that during market pullbacks, JEPQ historically loses less than pure tech ETFs, while still maintaining strong income payouts. And during sideways markets, the option premium income can actually allow JEPQ to outperform traditional growth ETFs. One of the most powerful aspects of combining SCHD and JEPQ is the income that the portfolio can generate. SCHD provides a strong quarterly dividend, while JEPQ produces extremely high monthly income. When you combine the two in an evenly split portfolio, the total annual income can reach around 7%, which is incredibly strong for a strategy that still maintains growth potential. But the real power isn't just the income itself, it's what you can do with that income. When markets fall and tech stocks struggle, JEPQ continues to produce monthly cash flow, which can be reinvested into SCHD at discounted prices, strengthening your defensive core. When tech stocks rise and growth momentum returns, you can shift some of SCHD's dividend income into JEPQ, increasing your exposure to upside. This creates a naturally self-balancing portfolio that adjusts based on market conditions without emotional trading or constant decision-making. This flexibility is exactly what gives this two-ETF strategy its long-term strength. It doesn't require you to predict market crashes or time rallies perfectly. It simply allows you to react intelligently using the income your portfolio already produces. For investors who want slightly different risk profiles, there are also alternative ETFs that can replace SCHD, such as DGRO, which focuses more on dividend growth with higher tech exposure, CGDV, which is actively managed and focuses on high-quality companies, or DIVO, which offers monthly income similar to JEPQ. These alternatives can slightly tilt the balance between growth and income, depending on personal goals. As we approach 2026, this strategy aligns perfectly with where the market is likely headed. Slower economic growth, increased volatility, declining interest rates, and rising demand for income assets create the perfect environment for a combination like SCHD and JEPQ. Instead of depending on one single outcome, this strategy adapts. It grows when the market grows, it cushions losses when the market falls, and it continues to generate income no matter what direction prices move in. That is what makes this approach so powerful and so practical for everyday investors. To wrap everything up, you don't need dozens of ETFs, you don't need complicated trading strategies, and you don't need to gamble on short-term market predictions. With just two carefully selected ETFs, you can build a portfolio that generates reliable income, protects your capital, and still gives you meaningful long-term growth. SCHD provides the foundation and financial stability, JEPQ delivers the income engine and growth exposure, and together they create a system that works across different market cycles. If your goal is to build wealth while sleeping peacefully at night, this two-ETF strategy is one that truly deserves your attention. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't